Let's talk about what might be coming, because there's 4 different options, and 3 and 4 are interesting because they have 3A, 3B, and 4A, 4B. You'll see what that means in just a second, but there are 4 options of what could be coming from the best case scenario to the potential worst case scenario. And let's talk about the best case scenario first. The best case scenario is that the plan by the government and the Federal Reserve Bank works amazing, where now you have an economic recovery, people are going back to work, interest rates, the I, is going up, and so now that's also bringing inflation down. This is what the Fed and the government are working for, where they can raise interest rates, which will bring down inflation without hurting the economy. In fact, it helps the economy go through a recovery, because right now our economy is slowing down. We saw an economic slowdown in the first quarter of 2022. We're seeing sales get hurt across the country. Just look at some of the biggest retailers like Target and Walmart. They are getting slammed because people are struggling being able to buy things. And so the best case would be we have a recovery. If this is the scenario, if this is what happens, if you have this best case, then the stock market will probably see a lot of gain, because people will realize, oh, the world is working again, we have nothing to worry about, and people will pour their money back into the markets. The second option is kind of like the best case scenario for a lot of people now, where this is what people are hoping will happen. You have a lot of banks on Wall Street that are hoping this, you have a lot of corporations that are hoping this, and you have a lot of economists that are hoping this, where you're going to see a dip in the economy, but the Fed will continue to raise interest rates slowly, and this will slowly bring inflation down. So this rising of interest rates will hurt the economy. It will cause a short-term dip in the economy, but this slow rising of interest rates will also bring inflation down. So we'll see a dip in the economy for the next year or two, but this will also bring inflation down, and then we'll be able to grow again, because now we will have fixed the inflation problem, and then the economy will be able to get out of this dip. This will ultimately hurt the stock market in the short term, but relatively quickly after, you will see it pick back up again. Option 3A is we go into a recession, which means we go through a bigger economic dip. More people lose their jobs. We see more layoffs. We see more hiring freezes. We see more unemployment, which hurts the economy. And at the same time, the Fed still tries to raise interest rates, even though we're in a recession. So now the economy is slowing down, and we still have a big inflation problem. So the Fed keeps raising interest rates, and eventually they're able to bring the inflation problem down, because the Fed continued to raise interest rates even though it hurt the economy, because raising interest rates makes doing business more expensive. So they raise interest rates even though it hurts the economy, but they're able to solve the inflation problem, and then this will cause us to go into a recession. This would cause more pain to the stock market than something like this would, because now the Fed will continue to fight inflation even though the economy is hurting, which hurts the economy even more, and ultimately that would be reflected in the stock market. So that would lead to an even bigger drop in the stock market, because now people are worried and they have less money to put in the stock market, because rising interest rates pulls cash out of the economy. However, there's an alternative to how 3A can go. The alternative to 3A now is you enter this recession, because the Fed is trying to fight inflation. Right now, the Fed is still working to raise interest rates. However, the Fed then changes course. If the Fed then says, okay, the economy is struggling, people are losing their jobs, people are unemployed, we have a big economic issue, right? This is the economy side, this recession is the economy. So then the Fed changes their mind, and now instead of continuing to raise interest rates, they start cutting interest rates. So now you start cutting interest rates, it makes it cheaper to borrow money, which causes now inflation to go back up. So in this case, the Fed then starts to ignore the inflation problem, and they focus here on the economy. If this happens, this would push inflation back up. If interest rates go down, that could help the stock market and other asset prices continue to inflate, which might sound good if you're an asset owner, but if you don't own the assets, it makes it even less accessible for you to now go out and buy assets, because if 6 months down the road, the Fed starts cutting interest rates again, what does that mean? Institutions can borrow more cheap money and keep inflating markets with more of this cheap money, helps the stock market, and that also means that people can go out and start buying homes again with cheaper mortgage rates, which pushes home prices up even more. So it starts to create more of an affordability issue, and because of inflation, that makes it harder for everybody to just afford the cost of living. So this is possible if the Fed turns around and they say, we don't want to fight inflation, we want to fight the recession. So it depends on if the Fed wants to continue fighting inflation, or or the economy. Option 4A, now we're getting into the worst case scenario type of situations where now we enter not just a recession, but a depression. A depression is a prolonged recession. So now we're talking about a much longer recession because the Fed doesn't have the ability to now stimulate the economy, because now the Fed is continuing to raise interest rates. We still have an inflation problem. And this means that we have entered stagflation. Stagflation means that now not only do we have an unemployment rate that's rising, not only do we have people that are losing their jobs, not only do we have wages that are struggling and if not going down, but we have a cost of living that's going up. And now when you're in this type of situation where the cost of living is going up and the wages are going down, this is where you're in a really tight bind, because now the Fed can't just stimulate the economy to get us out of this mess. That's what we saw happen in 2008, where we saw quantitative easing. It's what we saw happen in 2020. We saw unlimited quantitative easing. It's what we saw happen in 2001. We saw a lot of quantitative easing. In all of these crashes, the Fed was able to do some sort of stimulus or quantitative easing to stimulate the economy. But if you run into a situation where now you have high unemployment, which means you have a lot of people not working, that means wages are going down, but at the same time the cost of living is going up because of high inflation, the Fed can't do the same type of quantitative easing, because that would make the inflation problem even worse. Quantitative easing is an inflationary process, meaning it adds more dollars into the system. So if they did that, that's what causes things to get even worse. So in this situation, you enter this type of depression, you have some sort of stagflation, and the Fed keeps raising interest rates, which hurts the economy even more, but ultimately it helps to save the dollar, which will help the economy recover. It would just take more time. And then we have the even worse scenario, which is 4B, where in this case now you enter a depression, a prolonged recession. You have a lot of people losing their jobs. You have unemployment that's very high. You have a higher cost of living. You have lower wages. So a lot of people are struggling. And then the Fed starts to cutting interest rates. They want to cut interest rates to help stimulate the economy. However, it doesn't work because of all the inflation that we have. And then that pushes inflation even higher, making the depression even worse. And this is where now you enter something like a Great Depression. You start to enter really bad economic times where now the dollar is losing its value very quickly. You risk potential hyperinflation. Now, of course, the United States is the strongest military presence in the world. We have the strongest economy in the world. We are the world's reserve currency. All these things make any sort of hyperinflation much less likely. So for anybody who's saying that hyperinflation is coming, just understand that we have a lot of things going for us. However, if we enter this type of depression, because now the Fed is trying to raise interest rates to fight the economy, and then we really start struggling. Our economy really enters a deep recession, and we enter a depression, and then they start cutting interest rates significantly, and now we face an even bigger inflation problem. Well, now this can really put us into a much longer, prolonged depression, and it can really devalue our dollar, which could actually crash asset prices the opposite direction. So typically when we think of an asset crash, a stock market crash, we think of stock prices going down, house prices going down. But if you see the opposite, it would be stock prices crashing upward, real estate prices crashing upward, because there's such a large injection of capital into the economy. And while that might sound good, it hurts a lot of people, because now you will see a massive, massive wealth gap between the rich and the poor, and that would create a lot more issues, not just in the economy, but in the country, because anytime you start to see a massive wealth gap like that, well, then you start to see a lot more uneasiness, you start to see a lot more just anger amongst people, and it creates a lot more issues in a society. So you don't want to have a massive wealth gap like that. And those are the type of risks that you risk if you run into a massive depression. You're still fighting massive inflation, and then the Fed starts turning around on the inflation problem, and then they work to fight the economy, which ultimately makes this worse. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide that goes over what passive income is, how to start generating passive income, and different passive income strategies. These are things that you can start doing even if you don't have a lot of money. So if you want to read this free guide on how to start generating passive income for free, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.